How to sell the high or better. An article I wrote for the Van Tharp Institute that was entitled Same Trades, Different Views, Improve Your Results with Positive Reversion. I introduced the concept of the excursion ratio, which I now call the capture rate. The capture rate uses two different inputs. The first is what we call the maximum favorable excursion. And the maximum favorable excursion is the furthest that your trade went in your favor during the life of your trade. And then the second number is the actual profit. When we take the profit and we divide it by the maximum favorable excursion, we get the capture rate. What the capture rate does is it actually measures how effective you were in capturing the move that benefited your trade. It takes advantage of what we call positive reversion entries and positive reversion exits that they help you to dramatically improve your capture rate. So what is a positive reversion entry or a positive reversion exit? Well, positive reversion entry is buying low. Positive reversion exit is selling high. It's basically buying low when you get in and selling high when you get out, or selling high when you get in and buying low when you get out. So the capture rate is measuring how effective you were at capturing the move that went in your favor. And one of the key aspects of being able to capture that high capture rate is using positive reversion. Now, let's talk about the fantasy of every trader. The fantasy of every trader, the dream revolves around the perfect trade in which you get long, you take no heat, the trade immediately goes in your direction, and then you exit the high tick of the move, watching the trend implode after you exit it. We all know that's not possible though, right? There's no way to sell the high tick with any regularity. You might get it once in a while and be lucky, but you can't do that. What if I could show you the way that you could sell the high tick, or even better than the high tick? What if I could show you how to get a capture rate greater than 100% of the move? You'd probably want to grab the proverbial bullshit flag and throw it because you know I cannot be telling the truth. Well, let's see. How do we get capture rates greater than 1? By using options. One of Van's core principles is that you need to have large wins to be a great trader. And Van used to preach that, Dr. Van Tharp used to preach that the threshold for a big winning trade was a minimum of 3R, 3 times of reward, 3 times your risk. It needed to be a minimum of 3R or greater. One of the things I preach is that large winning trades are the secret sauce of great trading. Everybody goes for win rate. It's not about win rate. It's about big wins. This is one of my all-time favorite quotes. And I studied Paul Tudor Jones a lot. He's actually a friend of mine. I had conversations with him about this, and I know people who have worked with him extremely closely. So not only do I know Paul, but I know people that have been involved in Paul's trading at an intimate level. And one of Paul's fundamental principles, which I borrowed from him, is this idea of 5 to 1. Paul would say 5 to 1 means that I'm risking $1 to make $5. And what 5 to 1 does is it allows you to have a hit ratio or a win ratio, we'd call it, of 20%. Paul would say I can actually be a complete imbecile. I can be wrong 80% of the time and I'm still not going to lose. So if you think about what Paul's saying, if he's right and he makes 5 and he's wrong and he loses 1, if he has an 80% win rate, he's actually going to be up 1R. In other words, he'd lose 4R, 4 losses times 1, and he'd make 5R in the one time he's right. So even though he's wrong 80% of the time, he would still be up money. Now, we built this table, and this table to me just tells the whole story beautifully. What this table does is it shows, it's a matrix of win rate versus reward to risk ratio. And what does your win rate need to be to break even at different reward to risk ratios? So what we can see is we have this concept called expectancy. Expectancy is also the average R, the average reward to average realized R. So one of the things we see here is that everybody goes for high win rate systems. So I view the minimum threshold for a good system is expectancy of 25 cents. So if you're under 25 cents, it's really just not worth your time. So what's interesting is that if I set up a system where if I'm right, I make 50 cents, and if I'm wrong, I lose $1, my break-even rate is 67%. I have to be wrong I have to be right. I have to be right 2/3 of the time, break even. At 50%, I'm down 25 cents, which is an awful system. And I want you to notice, even if I'm right 80% of the time, my expectancy is 20 cents, which is not even the minimum for an acceptable expectancy. Now, if we move over to 1-to-1, which everybody, it's like, oh, 1-to-1 would be great. Okay, well, 1-to-1, if you're right half the time, you break even. You don't make any money. If you're right 60% of the time, you make 20 cents, which is not even the minimum threshold. It's not to get over 60% that you actually, it's really about 63% that you actually get to what we would consider the minimum threshold for a good system. But if we look at what Paul does, if we go all the way to the right to 5-to-1, what we see is that for the break-even rate is 15%. And if we could be right half the time with a 5-to-1 payout, our expectancy would be $2. Now, I want you to step back for a second. Because in the 1-to-1 system, if I make $1, if I'm right, I lose $1 if I'm wrong, which most traders they're totally good with that. The best I could do, the best expectancy I could have, perfection, would be $1 expectancy. If I was right 100% of the time, my expectancy would be $1. I want you to notice the way Paul does it. At a 50% win rate, the expectancy is $2. It's double perfection, which is insane. If we looked at what Van teaches us to do at 3-to-1, at 50 cents, our expectancy is $1. It's perfection. It's the same as perfection at 1-to-1. That's how powerful this is. And you can see in the table we heat map this, and you can see as you go to bigger and bigger wins, it just changes everything. So large R winning trades have a massive, massive implications for your trading. It is the secret sauce. So if we believe that large wins are the secret sauce, then options are the ingredients of the secret sauce. So in addition, by creating large R winners using options, we can develop trades where the capture rate is greater than 1. So in addition to focusing on large R winners, Van would preach 2 key concepts. 1, know your objectives. Options give you the ability to trade with much greater precision than trading underlying, which supports you to create positions in alignment with your objectives. This is in a way that's not possible with stock or futures alone. The second thing Van would say is you have to know your market type. I call it the market environment. Well, options give you the ability to maximize the 6 market types by creating positions that make money when the market doesn't move. You can make money when the market moves, when you can make more money. You can put positions on to make more money when the market rallies slowly than long stock or futures alone. So if we were in bullish quiet, you could put option trades on that do better than just being long stock. And you could put option trades on that make more money when the market rallies fast, which would be bullish volatile than being long stock or futures alone. This concept is vital because when you can anticipate direction and volatility, you can pick an option structure that massively outperforms underlying alone. The combination of these concepts leads to a powerful schematic that creates trades that have capture rates greater than 1. So let me show you an example. This is in Tesla. So this is in one of our systems called the Reach Trader Mechanical System. So if we just did follow the rules by buying stock in Tesla, we could buy 100 shares of Tesla. We'd risk 1 weekly average true range for our stop. And if we did that, we'd be going long at 622.77, the 554.48 stop. And we'd be exiting on January 15th at 826.16. This trade would be a 2.98 winner. It's a nice trade. It would make $20,339. And the capture rate, which is excellent, is 77.7%. A couple other things that are noteworthy here too, is it would cost you $62,277 to put this Tesla trade on, and your return on capital is 32.66%. Now, we could instead buy 4 of the January 640, 780 call spreads in Tesla. They would both be equal to 100 shares. The exposure is normalized. Okay, so they both have equal directional exposure at the time of initiation. Here we're buying the call spread at $35.87. Our stop is at $18.80, and our target is $140. Well, this trade goes out fully in the money. It goes out at $140. So it generates a P&L of $41,652 or 6.1 R. The capture rate is 159%. So I want you to think about that. So we'll work through the numbers here. So it's 59% better than perfection. That's what the 159% capture rate tells us. So we go in here and break it down. We can take our $41,652 from our Tesla call spreads, and we can take this and divide it by $100, by 100 shares. This gives us a total profit of $416.52 per share. We're going to add $416.52 to our entry price of $622.77. So the entry price is where if we had bought Tesla. So we bought Tesla at $622.77. We're going to take this unit of profit, $416.52, and add it to it. This is going to give us an exit price of $1,039.29. So this is what we're going to use to calculate our capture rate. So the capture rate is the exit price minus the entry price divided by the MFE minus the entry price. So the exit price is $1,039.29. The entry price is $622.77. Divided by the MFE of 884.49 minus the entry of 622.77. This gives us 159% capture rate. By making this conversion, we can see that we exit our Tesla 159% better than the MFE of the trade. We not only sold synthetically at the top, we actually sold 59% better than the high. This happens all the time. So in our matrix workshops, we teach option strategies in the context of their implementation to create trades with capture rates greater than 1. One of the things we do is we help you understand how to define your objectives and structure your trades in alignment with those objectives. If you spend the time to master these strategies, they will have massive implications on your future trading success. So here's just some examples. We'll go through these quickly. But these are 4 different examples of an underlying trade that could have been substituted with an options trade in its place. So the first example is we sell 100 shares of SPY. This trade is an excellent trade, makes 3.84 R. But if we actually did a calendar spread in options instead, we would have made 11.79 R. Our second example, we buy 100 shares of Google. This trade makes 3.12 R. We could buy 10 Google butterflies, and it would have had an R of 11. There's a typo here. Then in the short call spread, we could have sold 1,000 shares of the TLT ETF, or we could have sold 40 call spreads. Well, the ETF trade is a winner by 0.23 R, but the call spreads are 0.81 R winner. And then finally, we could buy DocuSign, or instead of buying DocuSign, we could buy what we call long synthetic calls. DocuSign makes 6.67 R. It's an excellent trade, but if we did the calls, it would have been up 12.54 R. The other thing is all these trades have a limited risk profile. The underlying trade has unlimited risk. Yes, you have a stop, yes, but you could have a gap. All of these have a maximum risk point. So our psychology is an essential aspect of our trading success. I love what Van used to say. He said, we just trade our beliefs. What I find so interesting is how many people see these concepts repeatedly, but still have resistance to embracing the concept that will ensure their success. So, how about you? Ask yourself honestly, are you embracing the concept of hunting large R winning trades? Are you? Starts there. Then, do you clearly understand your objectives for each trade? Saying, well, I think it's going to go up is not enough. Are you willing to embrace using option structures to create trades with capture rates greater than perfection? Are you? That's freaking amazing. I don't know why you wouldn't. This is your wake up call. It is. It's your wake up call. What are you doing? This is your opportunity to adopt these concepts and improve your trading radically. We have what we call the Red Pill Challenge. It's a free challenge that you can take. It introduces you to options and starts to educate you on these concepts so you can start to understand them and embed them in your trading. There's a link right here for the 10-day Red Pill Challenge if you want to give it a go. It's amazing. Well worth your time. So that's it for today. Stay tuned every Tuesday for additional webinars where I'll continue to teach you different ways to take your trading to an elite level. Have a great week. Have a Merry Christmas. God bless all of you. See you next week. Bye.